Covered interest arbitrage is a trading strategy that investors use to try to profit from the differences in two countries' interest rates. For example, the interest rate in the Eurozone might be 15% per year, while the interest rate in the United States is 5% per year. Unfortunately, unfavorable exchange rates could eliminate investor profits. To avoid this scenario, covered interest arbitrageurs use a forward currency contract so that they know what exchange rate they will receive when they convert their investment back into their original currency. Investors need to know two things: the exchange rate when they initiate the trade. For example, €1 equals $1.39, the spot rate. And they also need to know that they can later convert euros back to dollars at a rate of €1 equals $1.35, the forward rate. For the trade to be profitable, this hedge must cost less than what the investor will earn from investing in the currency with the higher interest rate. Angela has $1 million to invest. If she invests at home, she will earn 5%, bringing her total to $1,050,000. But what if she uses covered interest arbitrage instead? First, she converts $1 million to euros to get 721,500 euros. This investment earns 15%. Bringing her new total to 829,725 euros. She then converts her investment back into dollars, receiving $1,120,129. Opportunities to profit from covered interest arbitrage are rare, especially in highly active markets where all market participants are equally informed. Also, the market usually brings any imbalances back to equilibrium when investors who identify such an opportunity place a flurry of trades in an attempt to make a quick, riskless profit. Their profits are typically small, and taxes and transaction costs can eliminate gains from covered interest arbitrage. The economic theory of interest rate parity states that the difference between the interest rate in two countries is equal to the differential between the forward rate and the spot rate of those two countries. This equity does not always exist, and thus allows traders to arbitrage option positions to earn riskless returns. For interest rate parity to exist, there must be easy capital mobility between countries, along with complete substitutability of assets. For instance, a deposit in a foreign bank is considered the same as a deposit in a domestic bank. If the nominal returns were different between the domestic and foreign deposits, investors would move their money to the bank paying the higher nominal return. Interest rate parity exists when the expected nominal rates are the same for both domestic and foreign assets. Any difference is due to expected appreciation or depreciation in the foreign or domestic currencies. For instance, if the domestic interest rate is 8% and the foreign interest rate is 5%, this means that the market expects the foreign currency to appreciate by 3%, or conversely, investors expect the domestic currency to depreciate by 3%. In that scenario, it doesn't matter if an investor invests in a timed foreign deposit and then converts the foreign currency to his domestic currency, or invests in a timed domestic deposit and then converts the domestic currency to the foreign currency.